Hello investors and future investors, welcome back to the channel. In today's video, I will show you one option strategy that can be used now if you're trading with a small account. This option strategy can also pretty much be used if you're broke. So, if you're new to the channel, thanks for stopping by. On this channel, we help you with option strategies, dividends, and other investments that can give you consistent revenue in order for you to grow your small account. We can all make weekly revenue if we want to. So I'll definitely show you what I'm doing on my end in order to generate revenue. Now, all I ask in return for this free content is an early thumbs up by you hitting the like button and consider subscribing for more ways to increase your investments. Welcome to Investment Gains. Let's jump right into it. Hello future investors and traders, welcome back to the channel. Today's option strategy can definitely be used if you're broke. And it literally says so in the name. This strategy is called the Poor Man's Covered Call, or PMCC for short. We will do a deep dive using a live example, and I'll explain my rationale for price selection, how you win or lose with this strategy, and tips to make you a better, less emotional PMCC trader. All you need to do is follow along and leave me a comment below if you have any questions. For today's video, we're going to be using Li Auto, ticker LI. Now, the PMCC comprises of two option strategies, which are the Leaps option strategy followed by the covered call strategy. A Leaps option is pretty much buying a call with a far out expiration with hopes that the stock price will appreciate over time. These options typically extend out 12 months or more, but for the PMCC, you can get away with a 6 months or 9 month expiration date. The more important reason why anyone would buy a Leaps option is so that they can control 100 shares of a stock without paying full price. This makes a lot more sense once you've seen the visual. So let's go. So here we are on Li's option chain, and let's first make sure it says buy and call. Now we're going to proceed to choosing our strike date, and like I said earlier, the strike date needs to be quite further out. We're going to be going with the January 17th, 2025 for this call. Now, we're going to proceed to choose our strike price below the current share price. Now, I'm going to be going with the $30 strike price, and I will show you my criteria I use for choosing my strike prices. And for that, we're going to need to go into the Greeks. So in order to go into the Greeks, you just hit the price. So the number one criteria I use when selecting my price is going to be the open interest. The number two is going to be my implied volatility, or IV, and the third is going to be the delta. Now, the open interest represents the amount of option contract that traders actually hold. This tells you that more than 3,000 traders already has gotten this option. The implied volatility, or IV, tells you the likelihood of the stock to move in any direction. So an IV of about 60 tells you that the stock has a 60% chance of moving in any direction, up or down. And if you're selling options, you want to select stock options with IV of 50 or greater. The reason for this is that the higher the IV, the more premium you receive, and vice versa. But be careful not to choose too high of an IV because it then becomes super risky. Now, the delta. The delta tells you the price movement in any direction per dollar increment. So if you choose an 80 delta, once the stock goes up to $1, your option will increase by $80 and vice versa. So now that you have a better understanding of my rationale behind which strike price I choose, let me show you the difference in some of the other strike prices by going into the Greeks once again. So we will close out this, and we're going to go to the strike price right above, which is the $32 call, and we will check out the Greeks. So with this one, as you can see, the open interest seems good. The implied volatility is quite similar. The difference here is the delta. The delta is 78, which is 2 points different to the 80 delta. Now this one would be a good call to buy as well, except for I like to get my delta as close to that $80 mark as possible. Now we're going to be going with a strike price right below the $30, and that's going to be the $27 call. Now the $27 call, right off the bat, I can tell you I'm not going to be going with this one, and I'll show you the reasons why. Once again, the open interest is way too low. It's only at 146. The implied volatility is not too bad. However, the delta is a bit high. I can go with this. The only red flag for me is the open interest is just way too small. Now that you have a little better understanding of the Greeks, I will link a video above and also in the description below. Now, as you can see here, the current price of Lee stands at $40.79. So you would have to pay $4,079. But by acquiring the Leaps option, you're now able to control 100 shares for a lot less, which is going to be just $1,700. So we're going to go ahead, we're just going to hit review and we're going to proceed to purchasing this long call. Now, before we get into the second part of the PMCC, which is the covered call aspect, just an update for you guys. I will be doing one-on-one option consultation for anyone that's interested. Just go to the link in the description below and book your call with me. Each call will be 1 hour long, in which I will help you with getting started with options, and this does include getting your level 3 options access, day trading rules, margins accounts, SEC minimum limits for options account, not to mention we will be doing live examples. It's like I always say, there's no better way to learn options than to get down and dirty with options. So check out the link in the description below. Now, let's get back into this video. So now that you control 100 shares of Lee Auto, now I'm going to go ahead and we're going to start selling weekly covered calls. So now we're going to go all the way back. Now we're going to make sure it says sell and call, and now we need to choose our expiration date as close as possible, and I will be going with the expiration date of September 22nd. Now, when selling covered calls, it's always better to choose an expiration date as close as possible as to not give the buyer of the option enough time for price action to move in their favor. In much easier language, this translates to the closer the expiration, the less time the buyer of the option has to be correct. So we will go ahead and we're going to select our strike date. And then now I'm going to proceed to choose my strike price. I will be going with a strike price of 43.5. Let's go ahead. We're going to select that. Now, I know you're asking yourself, why did I choose that price as opposed to another, which is going to be the 44 or even the 43? And here's why. Let's go into the Greeks once again. Once again, to get into the Greeks, all you need to do is just select the price and it will open up. Now, I do choose my strike price based on 2 reasons. The number 1 reason is going to be my chance of profitability. I like to look for a chance of profitability of 80% or higher. And as you can see here, this is close to 85%. Now, reason number 2, once again, is going to be the delta. Now, if you remembered correctly, we did purchase our Leaps option at an 80-ish delta. So now I have to look for a 20 delta or lower when selling my covered calls to keep the balance. And if you're using this strategy, I highly suggest you choose your delta as low as possible while still making a decent premium. Now, just a quick reminder, my delta of 0.2 or lower, or my chance of profitability of 80% or higher, is based on my personal preference, based on my experience and risk factor. I tend to favor chance of profitability at 80% or higher, and everyone has their own preference based on their due diligence and their risk tolerance as well. So that's my rationale for choosing my strike prices when I'm using the PMCC. Now, at this strike price, you will be receiving a $31 premium. Now, once again, each option contract is multiplied by 100. So we're going to hit continue. We're going to choose him on a contract, which is 1. And right here you have it, a minimum credit of $31. Now, this $31 minimum credit is pretty decent. I say it's decent because it represents an almost 2% return on your investment. Now, in order for you to get the return on your investment, all you need to do is divide your premium of $31 by the price you actually paid for your long call, which was $1,700. And that should give you almost a 2% return. So how do you win with this trade? You win with this trade once the share price moves either higher or it just trades sideways. Remember, time is working for you. Now, you can lose this trade if the share price goes down towards your $30 buy call, and it will look like you're losing money on a regular basis due to the market fluctuations. But I can tell you, you're not. With an 80 delta, Any movement in the stock price of $1 up or down will also create an $80 move in your leaps, as I mentioned earlier. So it makes your portfolio look volatile if this trade is a huge part of that portfolio. Markets fluctuate. That's just what they do. Trust your decision and carry on with your life. It will also help not to look at your portfolio often, which forces you to make emotional decisions. Now, on to covered call. How do you win with covered calls? Well, with covered calls, you win on a weekly basis once the share price does not hit your sell call, which in this case is going to be $43.50. And when that happens, you get to trade again the following week to continue generating weekly premium. Now, if the stock price does go above your sell call of $43.50, then you're left with two options. No pun intended. Now, both options are viable alternatives depending on the outcome you're looking for. Now, here are a few tips that will help you trade the PMCC option strategy a bit better. Always do due diligence and stick with it. Remember, the reason for buying leaps is because you're waiting on the stock price to go up higher, and you did give yourself enough time, so just let it be. Hence, you chose a far out expiration date. Tip number 2. If you trade in the PMCC and you're not getting decent premium for selling your covered calls, don't force the trade. Skip a week if you have to. Remember, you're risking losing your leaps, which will give you stock appreciation in the long run to get a few dollars weekly. Tip number 3, manage your investment. Learn when to roll over your options or leave it to expire. This will allow you to make better decisions. And lastly, follow investment gains and check out the links in the description below. Now, I know this was a lot, so let's all put it together and I can show you the simplicity of this strategy and the time it takes to implement, which should be less than 2 minutes. Okay, so here we are, and once again, we're going to put it all together. Firstly, make sure you do your own due diligence and choose a correct stock. Once you get that, you go to the options chain and you make sure it says buy and call, and then you proceed to choose your expiration date far out. And as I said, we're going to be going with the January 17th, 2025. Now, proceed to choose your strike price below your current share price, and in this case we did decide to go with the $30 call. We're gonna go ahead, we're gonna select that one, we're gonna hit continue, choose the amount of options, which is 1, and there you have it. There goes, we have just purchased our leaps option. Now we're gonna go ahead and we're gonna start selling covered calls. In this case, let's make sure it says sell and call, and we're gonna choose an expiration date as close as possible. We're gonna be going with September 22nd. Once we have done that, now we're going to proceed to choose our strike price above the current share price. And in this case, we're going to be going with a 43.5 call. And my reason for going with a 43.5 call could be different to your reason for choosing that strike price. I like a 80% chance or higher of profitability, as well as a 0.2 delta or lower. We're going to go ahead, we're going to select it, we're going to hit continue, we're going to choose the amount of contract, which is 1. Once again, and there you have it, the PMCC in less than 2 minutes. Now, we have lots of investment strategies on this channel, so if you want to join the weekly income team, like and subscribe right now. Also, hit the notification bell right now to get an alert whenever I post a video. But most importantly, please share this video with someone you think can benefit from its content. Let's help as many as we can. Remember, a salary will give you a living, but your investment gains will give you a lifestyle.